Hello, everyone. Welcome back to the Septet Gates LLC YouTube channel. Today, we have an exciting topic to dive into the stock market. Whether you're a seasoned investor or just starting out, understanding how the stock market works is crucial. In this video, we'll take you on a journey through the basics of the stock market, key concepts, investment strategies, and some valuable tips to help you navigate this dynamic financial world. So grab your notebooks, because by the end of this video, you'll have a solid grasp of what makes the stock market tick. Let's get started. The stock market is a marketplace where individuals, institutions, and companies buy and sell shares of publicly listed companies. It provides a platform for investors to trade ownership stakes in these companies. These ownership stakes are represented by shares, which are also known as stocks or equities. When a company decides to go public, it offers a portion of its ownership to the public through an initial public offering, IPO. This involves issuing shares to investors in exchange for capital. Once these shares are publicly available, they can be bought and sold on the stock market. The stock market serves several important functions. Capital formation. Companies raise capital by issuing shares to investors, which they can use for various purposes, such as expanding their operations, investing in research and development, or paying off debts. Investment opportunities. Investors, both individual and institutional, can invest in shares of companies, potentially earning dividends, a portion of the company's profits, and capital gains. Profits from selling shares at a higher price than their purchase price. Price discovery. The stock market is a platform where the value of a company's shares is determined based on supply and demand dynamics. The stock price reflects investors' perceptions of the company's financial health, growth potential, and overall market conditions. Liquidity. The stock market provides liquidity, allowing investors to quickly convert their investments into cash by selling their shares. This liquidity is important for investors who may need to access their funds quickly. Corporate governance. Shareholders of a company have certain rights, including voting on key decisions and electing the board of directors. This helps ensure that the company is managed in the best interests of its shareholders. The stock market consists of various exchanges where trading takes place. Examples of well-known stock exchanges include the New York Stock Exchange, NYSE, and the Nasdaq in the United States, the London Stock Exchange, LSA, in the UK, and the Tokyo Stock Exchange, TSE, in Japan. These exchanges provide a regulated and transparent environment for buying and selling shares. Investing in the stock market involves risks, as share prices can be volatile and are subject to market fluctuations. Investors often conduct thorough research and analysis before making investment decisions, and they may also seek advice from financial professionals to help manage their portfolios effectively. The stock market operates as a platform for buying and selling ownership shares in publicly traded companies. Here's a step-by-step breakdown of how it works. Company goes public. A company decides to raise capital by offering ownership shares to the public. This initial public offering, IPO, is the first time the company's shares are available for public trading. Shares offered. During the IPO, the company issues a certain number of shares to investors in exchange for funds. This provides the company with the capital it needs for various purposes, such as expansion, research and development, or debt repayment. Listing on exchanges. After the IPO, the company's shares are listed on a stock exchange. Stock exchanges are platforms where investors can buy and sell shares. Examples include the New York Stock Exchange, NYSE, and Nasdaq. Investor participation. individuals, and institutional investors, like mutual funds, pension funds, and hedge funds, participate in the stock market by buying and selling shares. They can do this through brokerage accounts or online trading platforms. Order placement: investors place orders through their brokers. There are two main types of orders. Market orders: instruct the broker to execute the trade immediately at the current market price. Limit orders specify a target price for the trade. The trade will only be executed if the market reaches or exceeds the specified price. Order matching: stock exchanges match buy orders with sell orders. When the price specified in a buy limit order matches or exceeds the price in a sell limit order, a trade occurred. This price point is known as the equilibrium price or market price. Price fluctuations: the price of a stock is influenced by supply and demand dynamics. Positive news about the company, industry trends, economic data, and other factors can cause demand to increase, leading to price rises. Negative news can lead to price declines. Market indexes: like the S&P 500 or Dow Jones Industrial Average, track the performance of a group of selected stocks. They provide insights into the overall market's health and trends. Trading sessions: stock exchanges operate in trading sessions, typically during business hours on weekdays. Pre-market and after-hours trading may also occur. Regulation and oversight: regulatory bodies, such as the U.S. Securities and Exchange Commission, SEC, oversee the stock market to ensure fair trading practices, transparency, and investor protection. Investor goals: investors can have varying goals, such as capital appreciation, buying low and selling high, dividend income, earning a share of company profits, or a combination of both. Volatility and risks: the stock market can be volatile, with prices subject to fluctuations based on various factors. Investments carry inherent risks, including the potential for loss of capital. It's important for investors to conduct thorough research, diversify their portfolios, and consider their risk tolerance and investment goals before participating in the stock market. There are different types of stock market. There are several types of stocks, each with its own characteristics and potential benefits. Here are some common types of stocks. Common stocks, thus, are the most common type of stocks that investors typically buy. Common stockholders have ownership rights in the company and may receive dividends if the company distributes profits. They also have the right to vote on certain company decisions at shareholder meetings. However, common stockholders are generally last in line to receive company assets in case of bankruptcy or liquidation. Preferred stocks: preferred stockholders have a higher claim on company assets and earnings than common stockholders. They usually receive fixed dividends before common stockholders and have a higher priority in receiving assets in the event of bankruptcy. However, preferred stockholders often do not have voting rights or have limited voting rights compared to common stockholders. Blue chip stocks, block stocks, refer to shares of well-established, financially stable, and reputable companies with a history of consistent performance. These companies are often leaders in their industries and tend to have a history of paying dividends. Growth stocks belong to companies that are expected to experience above-average growth in revenue and earnings. These stocks often reinvest their profits into expanding their business rather than distributing dividends. While they can offer substantial capital appreciation, they can also be more volatile. Value stocks are shares of companies that are perceived to be undervalued by the market. Investors believe that the stock's current price does not reflect the company's intrinsic value, and they seek opportunities for price appreciation when the market recognizes the true value. Dividend stocks. Dividend stocks are shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These stocks are favored by investors seeking regular income, along with the potential for capital appreciation. Income stocks. Income stocks are similar to dividend stocks and are chosen for their consistent dividend payments. Investors, especially those seeking income during retirement, often invest in these stocks. Cyclical stocks. Cyclical stocks belong to companies whose performance is closely tied to the economic cycle. They tend to perform well when the economy is growing and consumer spending is high, but they can experience declines during economic downturns. Defensive stocks. Defensive stocks belong to companies that are relatively stable, regardless of the economic cycle. They provide essential products or services that people continue to use even during economic downturns. Examples include utilities and consumer goods companies. Small cap, mid cap, and large cap stocks. Stocks are often categorized based on the company's market capitalization. Small cap stocks are those of relatively small companies. Mid cap stocks belong to medium-sized companies, and large cap stocks are associated with large, well-established companies. Penny stocks, PASTAs, are typically low-priced stocks issued by small companies. They often trade at very low prices per share and are considered highly speculative and risky. Tech stocks, healthcare stocks, etc. Stocks can also be categorized based on industry sectors, such as technology, healthcare, finance, energy, and more. Investors often build diversified portfolios by combining different types of stocks to manage risk and pursue their financial goals. It's important to research and understand the characteristics of each type of stock before investing. Understanding key concepts in the stock market is essential for successful investing. Here are some important concepts to be familiar with. Stock. A stock represents ownership in a company. When you buy a share of stock, you become a shareholder and have a claim on a portion of the company's assets and earnings. Shareholders, individuals or entities that own shares in a company, are called shareholders. Shareholders have certain rights, such as voting on company matters and receiving dividends. Dividends are a portion of a company's profits that are distributed to shareholders. Dividend stocks provide regular income to investors, often on a quarterly basis. Market capitalization. Market cap is the total value of a company's outstanding shares. It's calculated by multiplying the stock price by the total number of shares. Companies are often classified as small cap, mid cap, or large cap based on their market cap. Price-earnings ratio, P/E ratio. The P/E ratio is a measure of a company's valuation. It's calculated by dividing the stock price by the company's earnings per share, EPS. A high P/E ratio can indicate that investors have high expectations for future growth, while a low P/E ratio can suggest the opposite. Earnings per share, EPS, is the portion of a company's profit allocated to each outstanding share of common stock. It's an important indicator of a company's profitability. Bull market and bear market. A bull market is characterized by rising stock prices over an extended period, often accompanied by investor optimism. A bear market, on the other hand, is characterized by falling stock prices and pessimism. Portfolio diversification. Diversification involves spreading investments across different assets to reduce risk. A diversified portfolio typically includes a mix of stocks, bonds, and other assets. Market index. A market index is a measure of the performance of a specific group of stocks. Common indexes include the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite. They provide insights into overall market trends. Volatility. Volatility refers to the degree of variation in a stock's price. High volatility means the stock price experiences large and frequent fluctuations. Brokerage account. A brokerage account is a type of account that allows you to buy and sell stocks, bonds, and other investments. It's typically provided by brokerage firms. Bullish and bearish. A bullish outlook indicates a positive expectation for stock prices to rise. A bearish outlook suggests a negative expectation for prices to fall. Market order and limit order. A market order instructs the broker to execute a trade at the current market price. A limit order specifies a price at which you're willing to buy or sell and will only execute if the market reaches that price. Short selling. Short selling is a strategy where an investor borrows shares and sells them, hoping to buy them back at a lower price to make a profit. It's a speculative strategy that involves higher risk. Fundamental analysis. Fundamental analysis involves evaluating a company's financial health, performance, and prospects to determine its value as an investment. Technical analysis. Technical analysis involves studying price charts and patterns to predict future price movements based on historical data. These concepts provide a foundation for understanding how the stock market operates and how investments are made. It's important to continue learning and researching before making investment decisions. And there you have it, a comprehensive guide to understanding the stock market. We've covered the basics, key concepts. Remember, the stock market is a tool for wealth building, but it requires patience, knowledge, and a solid strategy. As you embark on your investment journey, always keep learning, stay informed, and adapt your approach as needed. If you found this video helpful, don't forget to give it a thumbs up, share it with friends, and subscribe to the Septet Gates LLC channel for more informative content. Thank you for joining me today, and until next time, happy investing!